Hi everyone, this is Dr. Gregory and we're going to go over a quick overview of assignment number 1, which is our company transactions. Okay, you're going to be making some adjustments to the financial statements based on some transactions. And there's going to be 6 transactions and we're going to go over some examples to help you to understand this. You're also going to look at just a modified balance sheet and a modified income statement. So be sure you use the template we provide to you, okay? So there's the template and you're going to complete the changes based on the description of the transactions. Then you're going to provide just a little paragraph for what the characteristics of a balance sheet are, and a paragraph on completing the characteristics of what an income statement is, and then a small paragraph or just a couple sentences on the relationship we have between the balance sheet and the income statement, or the income statement and the balance sheet. So there's something that's going on that links those two together, and that's what I want you to write about. So hopefully you can see this. This is the template you're going to be working off of. And as I said, the template is in the assignment, so please just download it and use it. Don't use anything else. Don't create a PDF out of this. Don't create a Word document out of this. Just use this template. So the first thing we see is we're going to look at this. This is a balance sheet. And the balance sheet, you can see that the assets are in balance with the liabilities and the equity. And so this is what's called the accounting equation. Assets equal the liabilities plus any equity in the company. So you always want to make sure that as you are working on your template, and we'll see that a little bit below, that your balance sheet always stays in balance. If it gets off, that means you've made a mistake somewhere. You also have 6 transactions you're going to look at. You're going to sell some inventory to customers. You're going to purchase some inventory. You're going to receive some money from customers from the invoices you send out to them. You're also going to borrow some money from the bank. And you're going to pay your employees their payroll. So you'll show these as either increases, pluses, or decreases of the accounts for each event. This is the template you're going to be working off of. So this is, you're going to record the transactions and then you'll go into the second part of it. So for each transaction, 1 through 6 across, you'll be either putting in an increase or a decrease, or 2 decreases, as this example is, or increases. So you're going to have to think about each of the accounts and whether or not they increase when they gain or decrease when they reduce. Now, the second requirement is just to type in the characteristics of a balance sheet, of an income statement, and that relationship we talked about. So these are self-expanding sections. So just type, and as much as you type, it will just build it up more and more. Now, underneath your last answer, you're going to type your references in. They don't have to be APA formatted because it's very difficult to do that with a spreadsheet. But you do need to cite the sources of where you got your information from. Now let's talk about account classifications. The first one is assets. Assets are things that a company owns, like property, plant, and equipment, or cash. Inventory, if you are reselling something or you've got raw materials that you have in inventory. So those are things that we own. We also have ownership rights, and those are those accounts receivables because we sold something to somebody on account, meaning they got an invoice later. For example, when my landscape company comes out and fertilizes my yard, they will send me an invoice and I will pay off of that invoice. So the landscape company has ownership rights to my money because of the work that they did. Now, liabilities are what a company owes. So we owe accounts payable. We owe when we buy from our vendors and our suppliers on account, and they send us an invoice. So when they send us an invoice, then we have to pay it. Sort of like your credit card company. That's an accounts payable. Also a note payable. The difference between an accounts payable and a note payable is an accounts payable is short term. It's going to be paid off within a fiscal year. A note payable is longer term. It's like a mortgage. So we're going to pay over it over a series of accounting cycles or fiscal years. Now, equity is what is the residual after the assets minus the liabilities. Remember, assets equals liabilities plus equity. So if you want to know what the equity is, you take the assets and you subtract out the liabilities and you'll get the equity. Now, some of our equities are common stock or preferred stock, additional paid-in capital, and retained earnings. You'll learn about additional paid-in capital later on in the class, but right now just think of it as stock and retained earnings. Now, retained earnings are the accumulation of a business's profit over its life. So from day one, we are accumulating retained earnings. And the equation for that is the beginning period of retained earnings. For example, if your business fiscal year starts on January 1, then your beginning period retained earnings is that as of 12/31 of the year before. That's your beginning period. That's what we're going to start with for that year. Plus or minus net income or net loss, minus any cash dividends, and minus any stock dividends. And we'll get into cash dividends and stock dividends later. Finally, the last two account classifications are revenue and expenses. Revenue are just the earnings of the business, all the sales of the business, all the income of the business, regardless of when cash is received. For example, if I sell you a pair of jeans and I don't accept money for it, but instead I will send you a bill for it, so Gap will send you a bill for that pair of jeans, regardless of when you pay that bill, we consider that earnings to the company at the point of sale. That's very important to understand. So at point of sale, we have revenue. We don't care when the cash is received necessarily. We just want to make sure that if we sold those jeans in January, we're going to post that revenue in January, even if we don't pay the bill till February. Expenses are just the opposite. They are the operating obligations that we owe regardless of when the cash is paid. For example, sometimes you get paid the next month for the last month's wages that you earned. So those wages, the wage expense is in January, even though we're not going to pay you your employee paycheck until the beginning of February. So, for example, payroll expense, wage expense, rent expense, utilities expense. It's when we incurred that obligation, and it's always on the operations of the business. Now, accounts move. They increase and they decrease. So all we want to know in this is, when do we increase a transaction and when do we decrease in that transaction? Let's look at some examples. In assets, if the asset goes up, we increase it. If the asset goes down, we decrease it. So we received a payment from a customer's invoice. We've already sent them the invoice, and now we finally got paid. So our cash increases because we got paid, and our accounts payable decreases because that person no longer owes us. Another example could be if we bought inventory for cash. They're both assets. So when the inventory goes up because of the purchase, the asset goes up. It increases. Because we paid it with cash, cash decreases because we use that cash to pay the bill. Liabilities. If a liability goes up, we increase it. If a liability goes down, we decrease it. So if we pay cash to our supplier, our accounts payable, we reduce that liability. So cash goes down because we have to spend that money to pay the bill, but we no longer owe that bill anymore, so we reduce the liability. Now, if we borrow money from the bank, we increase cash because we got the cash, and we increase that liability because now we owe more to the bank. Equity. If we sell common stock to our shareholders. So usually we sell common stock in order to get cash. So we're selling ownership of our company for cash. Now to do that, if we sell that common stock, we increase the common stock number and we increase the cash. Now in another example, if we have a net loss that year, that net loss reduces equity in retained earnings. Remember, net retained earnings is beginning retained earnings plus or minus net income or net loss. So if we have a net loss or we pay out a dividend, we reduce retained earnings and we decrease the equity in our company. Now, if revenue goes up, we increase it. Now, revenue does not necessarily go down, not technically. It can be offset if we have returns and allowances. So if we sell clothes, we increase sales, right? Sales go up, we increase it. If we accept returns, we will offset those against sales. So sometimes you'll see sales as net sales. That means they've already netted out any returns and allowances. Returns is, you return clothes back to Shein or back to Temu because they don't fit or they don't look like they did in the picture. Now, here's something very important. When we make a sale, we have two entries we have to do. The first entry is to record the sale. So we sold some inventory we sold a pair of jeans for $50. If we do it with cash or accounts receivable, those increase and the revenue from the sale for $50 increases. Now the second entry we have to do actually records the reduction of the inventory because we sold it, right? So we will decrease the inventory by the cost of the inventory. So if we sold a pair of jeans that cost us $25, but we sold them for $50, in the first entry, we're going to record the sale at $50. But when we decrease the inventory, we only decrease it by the $25 because that's what it originally cost us. The difference between those two is our profit margin, right? So we're going to decrease the inventory and we're going to increase this very strange account. That's kind of a holding account. It's called cost of goods sold. So we decrease inventory by $25 and we increase cost of goods sold by $25. An expense example. Again, expenses go up, we increase them. We rarely reduce an expense. Usually that's just a correcting entry. We will never have a decrease of an expense. For example, we have expenses for rent, for payroll, for utilities. They're all called expenses to the business and they increase. We'll just record those as increases all the time. Every month we pay rent, we increase that account every month. Now, net income or loss is simply a basic equation. We take all of our revenue, all of our sales, minus all of our expenses, and that results in either a net income or a net loss. So if revenue is greater than expenses for the month or for the year, we make more revenue than we owe to somebody else. That's a net income. If expenses outpace revenue, that's a net loss. Now, sometimes companies at the beginning, like the first 3 to 5 years, may experience a net loss only because they're having to spend a lot of money to get their company going. But after that, they should be making money every year. If not, you kind of have a little problem, don't you? Now, some miscellaneous comments for this. Don't change the formatting of the spreadsheet. The calculations are all embedded. So it will automatically add and subtract everything for you. Note in the spreadsheet that there is a check calculation. This needs to be 0. If it's not 0, it means you made a mistake in one of the transactions. Remember that balance sheets are always in balance. Assets equals liabilities plus equity. If that isn't correct, then you've made a mistake somewhere. Now, only record the net income or the change in retained earnings at the end of the accounting cycle. Some students like to do it after every entry, but it technically isn't an entry that is made. It's usually at the end of that fiscal period, end of that accounting cycle, that we do that. At the bottom of the spreadsheet, remember to include your references. They don't have to be in APA order. And you can cite the book, the chapter, and then give me the actual page number that you're getting your information from, okay? If you have any questions, please let me know. We'll go over this in our Sunday Zoom class. Once I figure out what date would be the best, what time zone would be the best time zone to do this meeting in, okay? But if you have any questions, please give me a call and I'll see you in the classroom.